Hi and welcome to Equities Bank. My name is Jonas, I'm head of asset management, and I will try to, as rapidly as possible, go through some 80 slides of what's happening in the world in our view. And I would try to make this a bit more condensed than I usually do, so please bear with me, but I would try to go through this more quickly than I'm usually able to. Now, first of all, I think this is a very special year, as you remember from my previous videos, where we have both yields, the fixed income market and the equity market doing equally bad. For us, this means that tactical asset allocation is 100% dominating our investment decisions. Our global equity portfolios are up since we called the bottom for us in June, which makes this current environment extremely exciting in the sense that we can see that the broad indices are experiencing troubles. Meanwhile, our chosen global equity strategies are growing in returns. On top of that, we obviously help our currency bets, increasing that even more. Out of 28 different global equity strategies, there are about 24 to 25 that are showing that they're beating the global benchmark since June. And which is more important, we're up about 6-7% depending on which portfolio you look at. So for us, this is a very good year for tactical asset allocation, i.e. choosing India, clean energy, Japan, Latin America with the right FX overlay. That's the name of the game pretty much this year. It usually isn't this way around. Usually the strategic asset allocation is more important. But this year I would say that 100% is down to tactical asset allocation, which is sort of benefiting our investment strategy quite well because we like and we stand for being an active house in that sense. Now, obviously, we are making new highs in terms of our global equity performance versus the index. We're not making new lows. Far from it, I would say. Obviously, global benchmark is making new lows. So this is the difference. And obviously, it's a combination of the right strategies, but also the right currency overlays. We are in a tug of war between financial conditions and global macro, as which one is actually deriving, which one is the most important for global equities. We think it's very interesting to quantify these two aspects and follow them, how they develop in terms of the global equity market, financial conditions and global macro, and I'll come back to that. Now, we haven't changed anything in terms of our forecast since last week. We believe that we have seen peak hawkishness. We believe that we've seen, hopefully, it's the beginning of the peak yields. As I mentioned last week, this is not an actual position. This is sort of we've sneaked in this position indirectly, but it's part of our book, our game plan. And obviously peak inflation, that's more or less set in stone now. We believe also that we're going to have positive surprises on Q3 earnings. And we believe that we have risk reward on our side, i.e. we keep risk on equities. Why should we keep it on rates when rates are as bad? We have a lot easier to work with tactical asset allocation on the equity side. Now, we still believe that we're in a soft landing. We have these definitions the Fed laid out in June. We still see it being transforming. So for us, that is quite not relaxing, but quite stable, especially as the business cycle starts slowing down rapidly. And in terms of inflation, peak inflation in March, yes, I think that was a good call back in March. That was a bit more trickier than looking at the curve today and say, well, we peaked in March. But price inflation in terms of break-evens definitely peaked, and we're actually making new lows as we speak. We think that inflation as such will start to roll over. Remember, 22nd of October is a magic date where the base effects are rolling over and becomes like a wet blanket on top of the CPI numbers. And we can make some fun math by just increasing the CPI number by 0.1 or 0.2 or 0.3% each month, and we can see the trajectory. And it's interesting that deflationary outlooks are becoming more and more common in these calculations. We can also look at break-even curves and see the downside. Now, speaking of deflation, it's quite interesting to look at the supply bottlenecks, which are completely disappeared and withered away. And that makes, I think, Jeff Grundasch and others actually pointing a finger to deflation, because this is what has happened before. When supply bottlenecks are completely imploding as rapid as they are today, it has, in the past, sometimes led to quite, deflationary pressure or disinflation. Hopefully not the deflation, but definitely that type of pressure. This is obviously not the market consensus today, but this is actually where the market, in terms of the buy side, are starting to discussing these themes. What's going to happen after peak CPI, because the peak CPI is more or less set in stone. We can look at New York Fed's global supply chain pressure, same result, or the Creighton University Mid-American Purchasing Managing Index is the same thing. We can look at our own, it's the same thing. It's very hard now to come up with a supply bottleneck calculation that is anything to do actually with history that can actually show you a key or maintain inflation pressure. Now, I shouldn't have shown you this picture, but it's a bit of a nerdy picture, but it looks at brackets of increases in terms of inflation. We saw a change in the second derivative, that was March. So even though the actual headline is keep on growing, if you dissect the CPI numbers into different brackets of increases, you can actually see the peak in inflation back in March, which obviously corresponds very well to the market's priced inflation. This is sort of the nerd game that you have to do on the fixed income market side. And this has not yet transformed or been translated by the equity market. But this is why we keep the risk on the equity side, which I think we've had a free option this year, given the fact that the rates are doing equally as bad as equities. If that hadn't been the case, obviously we would have acted differently. If we weren't up in our equity market since June, we would be more concerned about the new lows in global broad indices. Now we actually have a sort of a crash pillow where we can work with positions in a completely different manner. Now we can skip this, but also do remember that the 1-year inflation outlook from consumers is below 3%, and again the curve is speaking as well. We already priced the peak in terms of fixed income markets. Now we're just waiting for equities to wake up, as I put it here, perhaps a bit blunt expression in that sense, but I think it's definitely worth keeping up and waiting for equities to wake up for that, and we can wait a longer time than most, given the fact that we caught the June trough, and for us it holds. Now in terms of CPI, we'll come back to that later on in terms of what's actually happened between Sweden and the US, but I think this picture is quite interesting. It's a bit nerdy, but it looks at the market probability of priced Fed fund future contracts to the next meeting, not the September 2021, it's actually the 2nd of November. And we can see that shock priced of 100 basis points in the market has now disappeared, and we settle down in a broader range of 75 basis points hikes. Obviously that laid the groundwork for what we think and hope will be a more constructive equity market. But you can see the waves here in terms of hikes and cuts and what's happening with the CPI data and different Fed fund data. Up here I put the Fed fund futures probability scoreboard, if you like, with different Fed meetings. And you can see that yes, we will hike, but not before long the market becomes a bit 50-50ish, and the probability tree, if you like, is starting to growing on the downside, i.e. we are anticipating and we'll be warm up and working to a cut going into 2024 and 2023 and 2024. Now obviously inflation is rising, you hike interest rates. Sweden is acting actually a bit like a laggard, which is obviously understanding given the conditions in Sweden, but obviously with other countries acting aggressively, more aggressive than Sweden is doing. Our currency is taking a beating, which is just one clue to it, but I think it's important to mention. Now we put our necks out last week and said we believe that yields will start to come lower. This is a slide before yesterday's move. And if you actually look at swap spreads, we think we have a good foundation for that move. And now obviously the 10-year swap spread is usually leading in the nominal Gavi bond rate, and sometimes it can be off. But this time around we think, with both macro and the swap spread on the downside, we think that's an interesting play. Now that could create a little bit of a problem for us, because obviously fixed income market will start to deliver positive returns. If that is not coincided, which it has been so far, by equal moves or even better moves in equities, we have to think twice again. Now financial conditions are tightening. As I mentioned, in the US and Europe, no news there. Obviously the conditions with a very low debt ratio in the US is quite constructive for the US. Now we're positive on equities. Now we quickly run through some slides for what that is. Now we see a turning in margin debt. We see that yes, given the broad risk indices, we saw a reason to reallocate, but we're not taking out new lows in our risk measurements. Hence, we do not take off equity risk in the market. Intermarket risk, i.e. the correlation between different markets, is low, which we're not being sucked, or everybody's not running to one side of the ship in that sense. So we're keeping a constructive view on that sense. If you're looking at the market extortion on the downside, we look at, for example, RSI and percentage moves, or the number of equities trading below the 50-day moving average. we chose those two indicators as those have been chosen by Bloomberg, and our thinking is, well, if we're looking at it, maybe more people are looking at this. And you can actually see the 20th being the magic barrier. And when we break this, we have a natural exhaustion on the downside. Worked great yesterday. We'll see what happens going forward. But again, given the fact that we have made some 7% since end of June, we can afford to wait and see what happens here. We are greatly encouraged by our daily trading models, which look at counterparty risk, dollar liquidity, and vol series, which is actually increasing in risk appetite, which I think is quite constructive. So we just hope that equity market will turn around to this. Maybe we have to wait until mid-October for the next CPI number, but it's definitely worthwhile hanging on for the time being. Now we also believe, and this is a long shot, but we also believe that we're going to get back to positive gamma. Our traction since 2022 has been poor in terms of predicting gamma. But again, it's a lot easier to be positive. We can actually envision or at least model the probability of positive gamma than the contrary. If you look at put call in terms of spreads, you can actually see that we're breaking this magic barrier, which usually tends to be the market trough as well, which we think is quite encouraging. And on top of this, the risk of a bear market is very low given Goldman's model. So our point being here that we can keep on, and pretty much all indicators we look at is constructive for the equity market. If you look at the PE number and we invert it, correct by the 10-year yield, and we put it on a cycle adjusted basis, we can actually see that we have a breakthrough, i.e. the equity market is already signaling that the market is signaling that the equity market is all of a sudden cheap, going from expensive to cheap from summer, which I think is quite constructive as well. And UUBL liquidity ratio is also showing some constructive buying at the end of the day, which is quite helpful as well. So for us, it's very difficult to be super bearish unless we think or imagine or we become scared, and that's not really how we manage money. And I will come back to show you a bit more on the business cycle of things. But before that, quickly, yes, we're still in growth. We're in narrow growth strategies. We're making money on those growth strategies. We think the fundamentals factors are for us for growth. Now we have to also remember that a year when we have priced recession already, and the fact that rates have been doing equally bad as the equity market, which I'm trying to envision on this side, where you can look at the price level of the ISM, which would be low 40s. We will not get to low 40s anytime soon. We think it's quite clear that you have a free option to stick to equities, which has been our game plan. Now, this is important. The earnings revisions are troughing, which is, I think, is quite constructive. And so we know that earnings for Q3 will be lower, and we're going to have negative results and all that, or more negative results on that. But the important thing is actually earnings revisions, and that's troughing. We already know that's going to be bad. And for us, this means that we have an increased likelihood of positive surprises. This black line is indicating that you're going to have beats in the market, and the black line is pretty much the difference between what corporates are saying about the sales and revenue compared to what analysts are saying about the same corporates' sales and revenue. So i.e. corporates are more bullish than the analysts, which I think is a great setup for positive surprises. And if you combine earnings revisions, price target revisions, and economic surprises, you end up in this regression model, which is a clear upside for Q4, which is our bet that will happen basically. Now, if you look at the macro, we still have a outperformance in terms of US versus European now cost models. We still see, if you look at leading indicators, etc., that things are developing the same way they were developing about a week ago, i.e. the US recession is about 25%, a little bit less than 25%. We know what the curve is saying, but also do note that the curve is a bit treacherous to trade on. And also if you correspond it to the European or the German curve, which we think to know, we're looking at the economic consensus, you have a 78% probability of a recession. You actually have a curve inversion showing 25. In the US, you have a 22% recession probability, but you have a curve inversion that stands at 65% of the curve is inverted. So again, we have to be a bit careful about how we read the different curves and how they actually work in terms of liquidity, trading, etc. So this is just sort of a nerd look into this, why we don't think that the curve as such is that great to model on. If you look at the curve the Fed is highlighting, they look a lot more on the short end of the market, i.e. 3-month, 18-month, and I quantify this by looking at FX forwards and OISs. And you can see that we're not really flattening in that sense, far from inverting. So again, we don't really see recession risk the next 12 months. We have a 22% risk given the credit markets and the Fed's own calculations. Hard data, nowhere near slowing down. High frequency models, they're not slowing down either. In fact, they're actually increasing again. I do remember that we have positive surprises in the US. If you look at the real-time SAM rule recession indicator, we're far from any recession levels. So for us, this is more of a 23-24 story, but then again, we already know that the Fed will cut rates by then. So it's really hard to trade on that today. And especially if you're given this free option to keep on to equities, we should take it. That's our call, especially if you can make money from just by trading the right currencies. Now, if you're looking at the official data used for timing US recession, you can see that we're nowhere near a recession anyway. And in fact, to make everything even more weird, you can actually see that, well, hang on a minute, you can actually see in OECD leading indicators, you can see a trough. From an OECD point of view, we've seen the worst in the business cycle already. We haven't even really slowed down in the US. This puts the onus on Europe, because you can also see the credit market is actually growing. In the US, it's exploding almost. Yes, they can hike rates. Global credit market is growing. And global trade is reaccelerating again. So we have an over 5% global trade. This means that the winners are greatly diverged from the losers. I come back to this blockification theory that I've been running for a while. There will be a clear the difference in the markets and also in growth, etc., between different regions, the US or North and South American region in that sense, the Asian region, and Europe in the middle. The losing end of the stick right now is Europe, which is why we have 0% on the Eurozone. The bit funny thing here is that the Swedish OMX market, i.e. equity market, is large caps are trading on US macro, which is why we can sort of hang on to the Nordics in that sense, and obviously stock picking in Sweden. Now, we will not go through the coming data of next week, but I would like to highlight the Swedish conditions, where we can now see, because we saw retail sales now for the second month in a row being on levels that we haven't seen since the great financial crisis or the 19th crisis. So we're hiking rates just when we already know that our consumption is imploding. We have a high debt service ratio. Our unemployment rate amongst adults and youth is not equal, but we're sort of in the same region as Italy, Turkey, Portugal in that sense. We're not keeping up with Denmark, Norway, Finland, US, New Zealand, Netherlands, Japan, Germany, Mexico, etc., etc. So we are sort of in a little bit different environment than a lot of the other countries. So we think this idea that we should hike rates just because everybody else is hiking rates, which is pretty much what Stefan Ingves said today, is a bit off given the fact that our consumption and our debt service ratio is what it is. For us, this is a pure SEK play. It's not an equity play in that sense. Because we have to remember that in terms of GDP, we can actually see still growth numbers in Sweden. Obviously now it depends on very much on which sector you look at. Yes, the export sector and manufacturing sector will be strong. The consumption side will be weak, i.e. trade accordingly. And this is sort of the name of the game for the time being. Now that was all for me. I will be back in a week's time with a quick update. So thank you so much for this time, and hopefully I didn't rush things too quickly. If that's the case, give me a note and I will slow down to next time or even make it even shorter. Thank you so much for your time.